Today we are diving into the high and low bands indicator, a powerful tool in technical analysis. This indicator helps traders understand market volatility and identifying potential price reversals. Hello, this is 𝗟𝗶𝗵𝗵𝗁 and let's take a closer look at how the higher and low bands indicator works and how it can benefit your trading strategies. The high and low bands indicator uses a triangular moving average as its foundation. This helps smooth out price fluctuations, making it easier to spot volatility and potential reversal points in the market. The upper and lower bands are calculated by adding or subtracting a percentage from the triangular moving average. As market volatility increases, these bands expand, offering traders insights into potential breakouts or reversals. Unlike Bollinger Bands, which adjust based on standard deviation, high and low bands offer a fixed range, making them more stable in trending or steady markets. This helps traders set reliable support and resistance levels. Traders use high and low bands to follow trends and spot potential reversals. When the price hits the upper or lower band, it could signal that the market is overbought or oversold, providing key entry or exit points. With LightningChart as a trader, you can customize your high and low bands to match your trading strategies, allowing for real-time analysis and quick decision-making in fast-moving markets. Start using it with LightningChart as Trader today to elevate your trading strategy.